Now, so I've already tried to allude to the fact that these tokens are not debt and equity. And I think one of the misconceptions, but there's other misconceptions about this, which is the way how the markets work and how the markets work in terms of their structure. Now, this is something that I've done a lot of research on, generally speaking, just on traditional markets, but also on cryptocurrency markets. So I'm going to try to explain this in a very, very simple graph here. Now, a very important truth is that we need to understand that a price of a cryptocurrency, of a token, should not be compared directly with the price of an asset. The price is established in a different way. So let's first talk about the traditional world. In traditional world, you have an investor. It could be a person or it could be a fund like Vanguard, and they want to make a trade. Right? What do? Well, they go to their broker, say Goldman Sachs. Goldman Sachs holds their account and holds therefore their assets and has a custodial relationship. And then if they want to make a trade, so if the investor wants to make a trade, they tell their broker, and then the broker sends the order that they have to one of various different trading platforms. It could be NASDAQ, like an exchange or New York Stock Exchange. It could be a wholesaler, a dark pool, an internalizer, and so on and so forth. If you want to know more about that, you have to, we have to spend another, entire course on that. But the bottom line is there's another set of regulated entities where the transaction happens, where there's rules and so on and so forth. And then eventually the trade will be settled using the DTCC and Broadridge and potentially the custodian bank, right? So that's essentially how a transaction works. Important part is brokers are regulated and the exchanges are regulated. There's a set of rules. Now, how does a crypto market work? Again, you can have the same investor. Now, there are two different types of ways how this investor can trade. The first one is they can go to an exchange, right? So now if they go to one of the cryptocurrency exchanges, like say Binance, what that really means is that they basically use the platform of Binance. But in order to use Binance's platform, they actually have to transfer their money from their blockchain account, from their blockchain wallet, into the Binance wallet. Another example is Polyonics. So if you want to trade your Ether, what you have to do is you have to take your money or your tokens or your Ether directly and put it into the wallet of the exchange. Then the transaction happens within the exchange, and then the settlement is your own job. So you take the money back out and put it back onto the blockchain. Now there's possibility of fees involved in the in and out transfer here. But the important part is that for a brief moment of time, the exchange actually effectively has custody over your assets. The other alternative is that you trade on-chain, right? So what you do is you write a smart contract to which essentially is a limit order, and you put this on the blockchain and usually use a service like Uniswap so that these smart contracts can be found on the blockchain, and then somebody chooses to trade against your smart contract. Now the part about that is that the money never leaves the blockchain, and actually you never actually lose custody over your asset because it stays within the blockchain. So you actually know at any point in time where you are. Now, what is the fundamental difference here? Well, the fundamental difference is that the exchanges in the cryptocurrency world are much closer to a broker than they are to a real exchange, right? Because the exchange basically is, in the real normal world, is just a pass-through of information, whereas the exchange in the cryptocurrency world is somebody who holds assets for you. And this is problematic because, all the hacks that you hear about for blockchain technology have usually occurred at the exchange level. So in the sense of that, then there was money was stolen because the exchange wallets have been hacked, information has been leaking there, or very famously, you have the Quadriga X exchange, scam that happened. Let me maybe I should talk about this for a moment. So Quadriga X, in case you haven't heard it, and I think Vanity Fair has a long story about this. Quadriga X is an exchange which was founded in Vancouver by a single entity. Now, it was also one of the exchanges very early on when I wanted to get some cryptocurrency myself, which was recommended to me. And what happened essentially was just as I said, you put money into the wallet of the exchange, and the exchange effectively has custody of that. Now, when you think of an exchange, you may think of the New York Stock Exchange, some major operation which has a lot of technology behind it, several thousand people employed. This one essentially had very few employees. It was effectively just one person. And what happened is that at some point, that person got sick and allegedly died. He died not anywhere, but he died in India. So he apparently was in India, got sick there, went to hospital and died. And there's a death certificate saying that he had died. Now, the problem was that with his death, he took with him allegedly the private keys of the exchange wallet, which means that nobody could access the funds that were in that wallet. But it gets worse. So eventually PwC was hired to look into these wallets and try to understand where the money was and to try to see if anything could be recovered. And they found out that these wallets were effectively empty. So now, how is this possible, you ask? Well, the way an exchange works, if you want to get cryptocurrency, is you need to send fiat currency to the exchange, which means you need to send it to a bank account. And then the exchange often sells you the cryptocurrencies directly so that you then can eventually take it out. Now, what these exchanges, many exchanges were usually doing is they sold you cryptocurrency. So there's two ways how you can buy and sell on an exchange. There could be somebody else who is an exchange user who sells you something, or the exchange can directly convert and just give you the money. The difference between the two is that when the exchange sells you money, you don't really know whether or not they actually have it, right? Now, and this works a little bit like the normal bank, right? So when a bank gives you, they basically give you money, it doesn't mean that they have the amount in cash available. So if everybody would run to the ATM, of course, we know this is a bank run and no bank has enough cash to satisfy all the deposit requests from people. And in some sense, Quadriga X was doing precisely that, right? So they took deposits in Canadian dollar, usually because it's a Canadian firm. They gave you cryptocurrency that they didn't have, and they banked on the fact that people would just trade on their own platform, that they would actually never take the money and put it on the blockchain. Anyway, so they sold something that they didn't have. So basically, the money was just lost. What can I say? Anyway, so much for trading.